Good afternoon, everybody, and welcome to Spring Consulting Group's employee benefit overview of the writing employee benefits in a captive and healthcare reform in a captive. I think we're going to go ahead and get started now. If anybody does have any questions, I'd like to introduce you to the Ready Talk format here. If you do have a question, on the left-hand side is the chat option where you'll be able to write us a question and we'll be able to respond to you. Those that are not logged into the audio, you'll notice that we do have a message to the left-hand side reminding all participants to please log into the audio of this call. I'd like to introduce you to this afternoon's speakers. We have John Cassell, who is the Senior Partner at Spring Consulting Group. John has over 20 years in experience in healthcare and financial services. He's a regular speaker at industry conferences and has contributed articles and papers to a number of publications and journals. John is an associate of the Royal Society of Medicine. Previously, John was partner in Watson Wyatt from 1997 to 2003. During this time, he set up and ran the Employer Healthcare Consulting practice in the UK and headed healthcare industry consulting globally. Most recently, he was the Executive Vice President of Watson Wyatt's U.S. Insurance and Financial Services Consulting practice. Next, we have Karen Landry, who is the Managing Partner at Spring Consulting Group. Karen has over 20 years of experience in the insurance, healthcare, and risk financing sector, and the benefits industry. She is an internationally recognized leader in captive insurance strategy, benefits, and financing. She was instrumental in establishing the first employee benefit program funded by a captive. Karen is the chair of the Captive Insurance Association and the member of the ERISA committee. She's also a member of the Finance Committee for Captive Insurance Education, Strategic Planning, and for the Vermont Captive Insurance Association, Program Committee for SECA, and Advisory Committee to SpecandAge.com.
The conference is no longer in listen-only mode.
Little about Spring Consulting Group, formerly U.S. Watson Wyatt Insurance and Financial Services Consulting Group, was a management buyout in March of 2004 to form Spring Consulting Group. Spring Consulting Group provides strategy consulting services to employers, insurance, and financial service providers, and capital.
The conference has been muted.
Spring offers subject matter expertise in retirement, life, healthcare, including retiree medical, disability, absence management, workers' compensation, captive insurance, and strategic risk management. Spring is governed by a non-executive chairman and an advisory board of industry experts, and Spring is 100% employee-owned. Recently, Spring Consulting Group was the winner of a Business Insurance Innovation Award for our patent, which is a patented process which enables employers to reduce the cost of their employee and retiree benefits by funding them through a captive. Next, I'd like to introduce Karen Landry, who's going to go present now an employee benefits overview and writing employee benefits in a captive.
Good afternoon. I'm really delighted to see so many people I know on the call and a few folks I don't know or I haven't had the opportunity to meet. What I'd like to do is start out by having you respond as to whether or not you have a captive. And by that I mean there are some service providers on the call, if they have a captive, if you could not respond yes if your primary role is a service provider as opposed to a risk management captive owner. I'm looking to gauge how many people we have who might have a captive, and then those that are either service providers or perhaps don't have a captive at all. So we're going to send out a little poll, and while that's being tallied, what I'd like to do is start out with providing people a little bit of a history. And for some of the people who are on the call, this is meant to be sort of an employee benefits 101 subject. I know some of you are well beyond the 101 area, but really most people think about funding employee benefits in a captive beginning with Columbia Energy in the early 2000s. That was followed, as many of you know, by Archer Daniels Midland, and then over the course of the last decade, there have been a number that have gone through the expedited DOL process to more than 17 others. And since then, there have been a few that have gone through the non-DOL fast-track route, have just gone and gotten an exemption, like Subaru, which went through the traditional individual exemption route. In addition, we've worked with a number of companies over the course of time on non-ERISA benefits, ERISA really governing, most employee benefit plans that we think of, retirement plans, group health, medical, dental, vision, disability, life insurance are typically governed by ERISA. Nowadays, people are moving into voluntary benefits, but those voluntary benefits would be some non-ERISA lines, along with supplemental executive retirement plans or deferred compensation plans for executives, and then group medical captives, primarily for stop loss, are all some of the things that have arisen more recently. In terms of beyond the DOL filings, the types of coverages have tended to change over the course of time. When we work with clients, usually they want to take a look at some of the simpler, easier benefits to implement, things like life, disability, accidental death and dismemberment, or long-term care, multinational pooling, perhaps with long-term care being a recent addition, multinational pooling having been around quite a while. So now people moving towards and looking at funding retiree medical, which has really started with Whirlpool and continued with Coke and on to pensions, which everyone's looking at the present time. So really quite a transition over the course of the last 10 or so years. So, why has employee benefits continued to grow in interest? Well, out of the back of the weak economy, many employers were looking to reduce headcount and benefits costs, and that's continued. I think that continued in terms of the benefit cost reduction. Luckily, the economy's picking up, but employee benefits costs are continuing to increase and fluctuate and consuming an ever-increasing portion of company profits. So I think going forward, companies are going to continue to be focused on how they can manage their employee benefits costs in a cost-effective manner. Often the benefits costs far exceed the cost of financing property and casualty risk. Not always, but in the U.S. economy, many of the companies that exist in the U.S. Are more service-based or based on intellectual capital, where people are really one of the high-cost items that they have as part of their bottom line. Many organizations we've worked with have looked at benefit funding really so that they can demonstrate cost-effective use of their captives. Perhaps it's short of their tax position. And the fact that many successful, well-known brands have funded benefits through captives make it less of an unknown and more of a commonplace solution. So retaining benefit costs at a lower cost using captive funding is less disruptive in some instances than eliminating benefits. Although I think that stopped, as the economy's turned around, we did see during the last couple of years that a lot of employers actually either curtailed certain benefits or they have moved certain benefits to a voluntary class. So many of you may already have an existing property and casualty captive. So you might be wondering whether or not employee benefits are a good captive risk. Aside from the significant savings potential, From an ERM standpoint, benefits are often one of the larger risks company face, as I mentioned. And therefore, many organizations are looking to include them to diversify their existing portfolio. And the law of large numbers really makes some of the lines, like life insurance and disability, perhaps more predictable than other lines of coverage on the property and casualty side that companies have looked at funding. Typically, on the bottom of page 9, we have a chart that gives you a range of savings for the different lines of coverages. Obviously, it varies from one entity to the next, but there can be some quite sizable savings that even for companies that are quite large and have focused on managing their employee benefits costs, we often see savings. I'd say 95% of the time we see savings out of the back of utilizing a captive. So what lines of coverage are people offering, and what lines make sense to fund in a captive? Well, the chart that you see in front of you on slide 10 is highlighted by check marks with the typical captive benefits that we see funded. Some of the benefits that aren't typically funded would include short-term disability. It's just too short. Usually there's not a big insurance component in it. Some of the other voluntary products, auto and homeowners, we're seeing an increased focus on funding these voluntary benefits, and that list of voluntary benefits is growing beyond what's there. Whole life, many companies offer group universal life coverage to their employees, and then some other fringe benefits like long-term care might be funded. When you take a look at funding employee benefits in a captive, often there's a trade-off between cost savings versus complexity. And part of the cost savings, aside from the percentages that we just showed you, really are commensurate with the size of the premium or the size of the liability associated with the benefit program. Typically, some of the simpler benefits to fund are the ones that everyone's seen go through the DOL process, or even some of the things that haven't had to go through the DOL process. So there are a lot of companies out there that have funded multinational pooling benefits through a captive and, have seen an increase in I'll try to talk a bit louder. I guess we got a comment I was hard to hear. Usually that doesn't happen, but please let me know if you're having a difficult time hearing me. So multinational pooling benefits funded through captives have been around for a long time. Many companies look to fund their multinational benefits to improve cash flow, to recover those dollars rather than waiting for a dividend, and to minimize the overall cost of their programs. And that's relatively easy and simple to do. You'll notice that multinational pooling benefits would not generally be an ERISA benefit, something that you have to look out for. We have had some clients where multinational pooling came under their ERISA benefit plans because they had basic life in the program, and therefore it ended up being an ERISA qualified benefit. So you just want to make sure that when you look at some of these lines of coverage, that any one of these can be voluntary or not subject to ERISA. So it's important to pay attention to the details, because just as it's probably 1 in 100 that has their multinational pooling benefits subject to ERISA, but it can happen. But basic life, AD&D, accidental death and dismemberment, active medical stop loss, are easy to fund, but they have relatively small payback. In terms of increasing complexity, long-term disability, supplemental life, non-qualified benefits being increasing complexity, and then post-retirement medical or defined benefit plans being more complex. And for those of you who work with retiree medical plans and defined benefit plans, just as a benefit, they're more complex. They're not off the shelf. It's just something that usually people tackle as a second or third stage. So if we take a look at slide 12, employee benefit advantages, are in line with what you'd see in many instances on the property and casualty side of the fence. You have improved cost management, acceleration of cash flow, reduced frictional costs. You can capture the investment return, improved management and reporting, increased control from a data, claims, profit loading perspective, improved risk management, and you can enhance the existing property and casualty captive if it's present. So each one of the captive programs we've worked on, really, although there are a lot of commonalities, many are customized to really meet the needs of the individual organizations, whether it's a Fortune 100, multinational, or a nonprofit charity. I mean, just as they all have different tax attributes, the needs and desires of those buyers would typically be different, and motivations would typically be different as well, with the Fortune 100 company wanting to save money versus perhaps the not-for-profit charity wanting to improve employee benefits and cover people like volunteers that can't necessarily be covered under existing programs. When you move to take a look at funding employee benefits and captives, you really need a whole team of people to become involved. Depending on the size of the organization and their internal decision-making process, it could involve any one of the number of folks you see here, with obviously HR and risk management being a key team member, with some of these others being less core to the existing team. So if you have a captive, you might already have a domicile selected. And obviously some of the things listed here I'm not going to go into every detail. You're going to want to make sure that from a domicile decision standpoint that you're aware of capital and surplus requirements, just the receptiveness of the regulatory environment, the quality of the infrastructure, and so forth. From this standpoint, the one thing that you're going to have to meet is making it subject to the U.S. and be licensed in a state from a DOL standpoint. So for those of you, perhaps the most important ones are the benefit experience and location. For those of you who have offshore captives, for example, with one client, we work with them, they had a Cayman Island captive. They had to bring it onshore. We set up a USVI captive in order to do that, and it met their needs because it was onshore for ERISA purposes, offshore for tax purposes. But others, we've worked with Bermuda captives that have come onshore in Washington as an example. Just, in terms of, like any captive assignment, you just want to make sure that somebody understands the various benefits, HR, accounting, policies associated with benefits directly from an actuarial, underwriting, and legal perspective, because benefits or policies tend to all be manuscript-type policies, meaning that they are all unique and different. So just to keep that in mind. Someone did ask a question saying, what about a branch? You would, if you had an offshore captive, need to form a branch so that you can make sure that you meet one of the Department of Labor requirements, especially if you're going to go down the fast track route for making it subject to, subject to the DOL requirements. So generally, we look at the four-phase process for funding employee benefits in a captive, and other folks have similar yet varied processes. Usually we look at a high-level analysis to see whether or not it makes sense to drill down in any particular benefits line with a deeper dive in terms of the actual design, plan review, and so forth, to implementation, actually getting the captive approved, moving through the DOL process, and then there's some ongoing roles that take place as a result of that. So particularly around the actuarial and reporting aspect. So just a couple of case studies before I pass this on to John. This is a nonprofit healthcare system with about 35,000 employees with an existing captive offshore. They wanted to fund basic and supplemental life, and they established an onshore captive through a branch with a fronting carrier. So they purchased the policies, the life policies, from the fronting carrier and reinsured 100% of the plan's risk with the captive. They did have some reinsurance that the fronting carrier provided, and they generated about $500,000 in savings on the total premium for this particular risk of about $3.5 million. So they did have to add an enhanced benefit to go through the Department of Labor fast-track escrow process. They provided enhanced coverage for spouse and dependents. They provided faster claims payments as well. So they actually improved their service by changing carriers and improved employee participation, particularly around some of the voluntary lines because of some of the savings that actually impacted the voluntary life coverage. In another study on page 18, we work with a global technology company with about 29,000 employees across 50 countries, about $20 billion in revenues. They had a pure captive in a U.S. domicile running property and casualty, mainly product liability and property insurance coverage. They also had a small insurance company, but their captive really didn't underwrite any third-party business, so they couldn't, they didn't have any deductibility. So one of the things that Benefits did for them was provided some savings, created the third-party business, increased their spread of risk and risk distribution, enhanced their existing capital and surplus structure, provided greater control for their U.S. benefits. And then on the multinational side of the fence, they had a couple of pooling partners, and that really was easier to implement on the one hand. I mean, if you look at multinational benefits, typically most employers have their multinational benefits. Some are pooled and some are not pooled, and in this case that was their situation. So we implemented the pooled benefits, and they've been working on rolling others into the pool as they go along. But what it did was it helped shore up their case of deductibility for their P&C premiums in addition to the cost savings it created. So if we looked at the financial results on the next page, again, I'm not going to go over every single number, but certainly some substantial savings. And in this instance, they had a retiree medical program that was unfunded, and moving forward to fund it actually helped create the savings that you see here. So all in all, that a pretty large amount of premium and a very good amount of savings, particularly over the course of time. And then lastly, a global energy company with 30,000 people, and you don't have to have 30,000 people. I realize that the examples we put in here just happen to be of that size. We've had companies as small as, with pure captives, as 1,000 people. This particular company had revenues of about $5 billion in 2009. They had a pure captive, again, only writing property and casualty coverage, domiciled in the U.S. and Vermont. We've moved forward to help them fund their retiree medical by making a tax-deductible contribution to a trust, which is a pretty typical construct, investing in insurance products for the captives to earn a more efficient rate of return. And so the advantages for them was that they were able to fund it in a cost-effective manner to get an increased rate of return compared to some of the other investment options they could have gotten through insurance, and gain an immediate tax deduction, and to have the assets supporting the unfunded liability on the parent's balance sheet. And then we've moved forward to look at funding pensions. Pensions generally are viewed in one of two ways, although we've had some other variations on the theme with regards to pension funding, either as a buy-in or a buyout/termination approach. And typically what the captive does is it purchases an annuity to cover all or part of the plan benefit payments. And in the buy-in approach, which is what's described below, the assets and liabilities respond similarly to the market, and the funded status basically stays level to make accounting and funding results predictable. And ultimately, unlike if you have an overfunded pension plan, you can't get those monies back, but the profits would flow through at the captive level. This type of a buy-in approach is often less expensive than a termination. Some companies may never move there, but in this instance, this company was looking to ultimately terminate, and so these are the types of savings that they'd be looking at, both from a retiree medical and a pension perspective. So with that, I'm going to turn it over to John to talk a little bit about healthcare in a captive. Healthcare from the benefits perspective.
Thank you very much, Karen, and thank you to everybody for joining us this afternoon. I'm just going to talk a little bit about what's going on in health reform and some of the opportunities that are emerging. I just thought it was worthwhile reiterating what a big issue healthcare is for the U.S. economy. We've seen that healthcare costs have overtaken profits since 2008, and some of the underlying drivers are unavoidable, like the increase in elderly population and the increased average age of the population. But on the other hand, there is significant expenditure acceleration there that is a major problem in the U.S. and seems to be almost too large to be dealt with, just like we have companies that are too large to fail. This is a problem that is almost too large to be dealt with. And if we do some comparisons with overseas, the high cost of healthcare is particularly alarming, since it is not correlated with better health outcomes compared with other countries, and we found that we basically have an inefficient system compared with many other countries who are spending a lot less, with inequality of access, rationing in some areas, overusage in other areas. So very fundamental issues that we're trying to deal with here. And as Karen's mentioned, the expenditure that we have on benefits, it's a major factor in making U.S. companies globally uncompetitive. It's a huge cost to organizations. In the small business sector, failure to pay medical bills is the dominant cause of bankruptcy, and what we have found over the last couple of years with the economy, that employer downsizing is driving up health and disability utilization as employees anticipate losing their benefits. So basically an environment where people are looking for solutions, and in the current economy looking for more solutions. So if we turn to healthcare reform, I'm always reminded of the eloquence of Bob Dylan here, where when I see what's going on, it certainly feels very much like All Along the Watchtower in terms of what's happening, and unfortunately what's continuing to happen, and therefore the environment is not at all clear. I've seen a lot of presentations on health reform over the last year or so, and everybody's consistent in their lack of ability to really predict what's about to happen. But let's talk about one or two things that we've seen. Certainly, despite Mitt Romney's denials, mass health reform is a model for major parts of current health reform. In Massachusetts, we've almost full coverage of the population, but enormous cost escalation. And there's a common theme of needing efficient health utilization management, which, if you look at the health reform overall, is one of the weaker parts and more likely to be diluted over time. And I think that's the area where we've got developments like ACOs that we'll talk a little bit about, which are still quite experimental in a lot of ways.
ACOs, for those who might not be familiar, are accountable care organizations, and John will get into those details in a bit.
Thanks. Currently, as you're aware, there are a number of states threatening the legislation in the courts. Insurers, we see, are increasing prices, partially because of inflation, but partially to cover health reform liberalization of coverage. And employers are confused, particularly small employers without the resources to keep track of change. It is an enormous pressure on HR departments these days simply to keep track of the variety of options that are available and the expectations of employees. Health reform on top of it has made life a lot more difficult for them, and particularly when initiatives that they're trying to plan for may be altered down or stalled. So what is interesting and is increasingly widespread is local initiatives at the state level, where I think a benefit of health reform, if you like, although perhaps not anticipated, is that on a state level there are some significant local initiatives taking place. Overall, there are about 17 states that have decided to take matters into their own hands, and particularly of interest is Vermont, that is basically deciding to leave the union, if you like, as far as healthcare is concerned, and some developments in Connecticut. But, I mean, all these are examples of people basically looking to do it for themselves, and I think that's a theme that we're particularly interested in. If we think about captives and how that works, I think basically the idea that captives creates greater control and that you can have a greater say in how you manage the cost exposure of your benefits and in some cases your health insurance benefits and still be able to take advantage of reform is a common theme here. Part of the issue for stop loss is that the introduction of unlimited maximums has impacted the ability to produce stop loss rates. That's not traditionally the way stop loss insurers work, and that's creating some issues, but I think a number of them are getting around that and actuarially determining what that risk is. SIRE's made considerable efforts to protect the self-insured environment, and I think overall they've been successful, and I can't see us moving away from that in any parts of the reform side. Karen's talked about retiree medical. There's retiree reinsurance in place, and there's the possibility of a captive solution to that as that is discontinued. We've just had a question saying, can a group captive or an RRG be used for benefits of multiple employers? I'm actually going to get on to that. The answer is yes and no. Yes, you can use a group captive. No, currently you can't use an RRG, but we would like to be able to use an RRG, and we've thought a lot about the mechanism for that, but there is some local state resistance to it at the moment, and we think that may change in the future.
Yeah, I mean, I think that there are a number of states where it's not possible to use an RRG, although technically it should be doable. It depends on the state that you go to, just to clarify that.
So Karen's talked a little bit about funding retiree medical through a captive, and I'm going to get her to come back and give another example with some more detail at the end. And retiree medical pools, I think we're very interested in the idea of pooling organizations with different retiree medical obligations, creating better buying power using a captive solution, and we think that's a real opportunity going forward. We mentioned accountable care organizations. The idea basically is that doctor groups or hospitals or chains of hospitals start to take responsibility for the health of the population and take responsibility for the cost of the health of that population.
We have another question. Can you use a captive with a PEO or a MIWA? Lots of initials there. You can definitely use a captive with either one of those. Generally, we try to work with employers. When you bring your group together, often it will, depending on how it's structured, look like a multiple employer welfare arrangement. Many states don't like those, and if you are going to be a MIWA, you may be subject to some state regulation and additional capital and surplus requirements treated like a regular insurer. So, we try to stay away from that and not have MIWA status.
Okay, so let me just finish on accountable care organizations. So there is an opportunity where the risk of medical inflation and cost is being passed to groups of hospitals or doctors, that there would be the need for reinsuring the excess of loss risk or adverse claims coverage as options that you could put through a captive, or set the ACO up entirely as a captive or a risk retention group, and that's creating a lot of opportunities in that area.
So just to, we did get another comment from someone in the audience about ACOs, accountable care organizations, being started by provider groups, taking risk from the health plan environment are very similar to provider-sponsored organizations of the 1990s. So just to pass that comment along, which is very, very true.
Okay, so let's just talk briefly about co-ops. Co-ops are a concept within the health reform that are going to be experimented with in 2013. They're non-profit member-run health insurance companies, a different structure than exchanges. Massachusetts already has an experiment working with co-ops. They're looking to set up six pilot programs, one of which is one that we're looking to do. But it's rather bogged down at the moment with insurance department red tape, and we're not sure how it will emerge, but at least they're trying to look at that. There is an option to fund co-ops through captives if the concept gets off the ground, and it can be a model for pooling of risks for smaller organizations. I know a lot of people are interested in trying to create group captives for small companies. There are risk factors that you need to take into account in how you structure these things, but a lot of it is legislative, is the restrictions in this area. So let's just go ahead.
Oh, I was going to say, although we are referencing Massachusetts and happen to be located there, the reason why we're doing that is just because it is, ahead of the curve in terms of exchange and healthcare reform, because it's been used as a model. Okay, so we think that within the infrastructure that employer group health captives are our preferred
recommendation in terms of how to structure programs. I think we believe that the structure can enable you to leverage buying power across the group. Captive funding allows appropriate pooling of risk, the elimination of state mandates, tax savings in some cases, and reduced reinsurance. So there's a number of advantages. They can be very much customized to the group that you're working with, and they provide the opportunity for carve-outs of various services that can be bought again in bulk. It fits very well with accountable care organizations because you can contract directly with them, and with insurer initiatives. As it happens again in Massachusetts, Blue Cross has developed this alternative quality contract, which is an ACO-esque type structure, and we would talk, we would be able to contract where appropriate with groups like that. Overall, it's an opportunity to move health insurance from an annually renewable, fluctuating program to a long-term cost management solution that you are familiar with on the property and casualty side. This is the way that we believe health care for groups or employers should go in the future. So here are some examples that we've been looking at. We've actually had a group of utilities running for over 15 years as a group funding retiree medical. There's a program that we set up about 7 years ago, which is a higher education association group in Washington, D.C., set up around a group captive. And then a couple of areas that we're currently working on, a state-based education cooperative for about 100,000 employees, and an industry association, again, looking to create a buying group funded through a captive. Talking about the Higher Education Association, I've put in a little bit of background information about that. This was a group that, through legislative change, found itself was suddenly a MIWA. It didn't suit the structure that it had, and we were able to work out a route to transfer it into a group captive environment and basically move the assets of the old structure into the new structure, and it's been up and running very successfully. It's got a variety of centralized support services, and basically they've been able to expand their offerings and attract and retain additional members. The last example of this I thought I'd mention would be a current program we're looking at for a group of organizations. They're spending about $1 billion on health insurance, and that is way more than they want to, and they're looking to reduce this cost. The program focuses on three areas. One is captive funding to consolidate purchasing and reduce frictional cost, centralized data management to start to benchmark and manage performance, and then focused health management. With a group of that size, you can design some very specific health management programs that are driven off the results of the data management that basically improve the health and productivity of the group. So you've got the combination of financial efficiency and health efficiency together. And because they're all 501c3s, we really wanted to set it up so that they would be able to continue to operate in a not-for-profit environment. So I'm just going to hand you back briefly to Karen to talk about a little bit more about retiree medical and another example.
Aside from the couple of examples I gave a little bit earlier, what's happening with retiree medical has been one of those benefits that employers have looked to cut, tweak, manage over the course of the last decade and a half or so. Some employers, though, since they're stuck with this liability, are recognizing the need to fund. And when you take a look at retiree medical, there's sort of two components. So many of the examples John just talked about are, the active medical plan. So you're looking at a year-to-year liability. Well, the retiree medical plan is a longer-term liability, but it also has this underlying one-year plan design component. A lot of the plans are continuing as is, meaning that they're leaving their rich benefit formulas typically in place, while others are capping plans, saying that they're only going to spend $3,000 per employee or something like that. And still others are allowing employees to use the employer as a group purchasing option, providing access only. And yet others are turning and offering individual programs and moving to an exchange-based benefit. So as these exchanges proliferate in every state, there's some question about that because Florida has challenged the constitutionality of exchanges. Some employers are saying, I might still provide the funding piece, but the year-to-year plan design piece, I may send all my employees to the exchange, my retirees to the exchange, and just provide them some level of funding based on their age and years of service, while others are just eliminating the benefit. So when you look at retiree medical, it's even broken down further because you have people who are eligible for Medicare, the post-65. They have plenty of choice in terms of products, but the people who are pre-65-year-olds have limited options, really, because if you're 50 to 64, you have a tough time finding medical coverage if you've had, at least in the past, any kind of illness. And so what happens is a lot of people stay on, their employer plans. So when you look at retiree medical, you not only have to look at the funding side, but in order to figure out the funding side and figure out what you might want to fund in the captive, you have to understand these basic dynamics. And so in terms of prefunding outcomes, most of the employers we've worked with want to improve balance sheet optics, through offsetting the post-retirement benefit liability with program assets, long-term cost savings when compared with a pay-as-you-go methodology, increased operating income, and that comes about because of the way retiree medical is accounted for through the reduction of retiree life and medical costs. Often the retiree medical or post-retirement benefit obligations are not only made up of medical, but we often include life, sometimes can include disability, and some other things. And then there are some companies out there looking to enhance employee/retiree security, which, if you're a cash-rich company, it's good PR for the marketplace. I'd say those companies are probably fewer and further between, but, that also is an outcome that we see in the market right now. So how would this work? I mean, captives mainly, parent company would make a contribution to Aviva. Aviva is a type of trust used in conjunction with employee benefit programs. The trust purchases insurance from a fronting company, and then the fronting company reinsures the program with the captive, secured by letters of credit, and the captive invests in marketable securities, whatever it might be. So, in any case, just to take a look at an example, we have a global company. They have an accumulated post-retirement APBO benefit obligation of $250 million. They don't pre-fund. They currently do pay-as-you-go. And the company had about $20 million in post-retirement medical and life benefits, net of Medicare reimbursements. And by using the captive in a strategy such as the one I've mentioned, basically it provided savings of about $4 million year one and $40 million in year 10. So, again, quite sizable savings relative to some of the other small lines of coverage. With that, again, this was meant to be a high-level overview. I know some of the questions are really good, detailed, meaty questions. We wanted to leave a few minutes for other questions to see if anyone had them as we went along today. Okay, I know that we have one question, which was, why?
Why do you think is there going to be growth in employee benefits, using employee benefits in a captive in the future?
I think our view is that as this process becomes more common, it becomes part of the tools that both risk managers and HR directors use to manage their costs, then I think it will become more commonplace, just as property and casualty funding through captives has become commonplace over the years. The other factors I think are important is the uncertainty in the healthcare market and in the benefits market and the need for control. I think people are going to look to use these types of vehicles to have a greater control over this part of their risk as an organization.
We've had a few questions. Somebody asked if a copy of the presentation is available. We will be mailing it out to everyone. And then the next question was, what do captives do to the role of the health insurer? Typically, not all, but most captive and health insurance programs have a self-funded underpinning with stop loss used as the insurance component piece. And so really for the fully insured programs out there, moving to a self-funded environment with stop loss is what they'd be looking at to utilize a captive. Except in limited circumstances, it probably doesn't make sense to use a captive for first dollar medical coverage because of the compliance issues. And then the next one, are there any problems using a segregated cell entity? There aren't necessarily any problems, but there are different things you'd want to just consider. Obviously, the first thing would be to want to see if it's a prohibited transaction at all. It may not be, depending on how the structure is arranged, as well as a number of other issues that you might want to take a look at. How many employee benefit captives are there in the U.S. today? There are probably hundreds, because I think that one of the things that people don't realize is that there are a lot of captives writing multinational pooling, deferred compensation, and other things like that don't require DOL approval. But what you hear about in the news are the ones that require DOL approval, and that probably today is somewhere up around 28, 30 that have gone through the DOL process, maybe even slightly more, as I know there are several pending. And there are medical stop-loss programs that have been in existence for years and years for captive, with some of the captive programs we work with. Another question is, do you have any existing models that would support the structure for captive providing health care benefits for employees of many different medical practices?
Yes.
So with the owners of the captive to be the medical practices themselves. Yeah, there are a number of different models that could be used in order to make that happen. The real issue would be the size of the medical practices, because in some instances you just have one or two people in a medical practice, and that, unless they're a bit bigger, is going to be difficult to roll into a captive environment. Will the audio included be with the handouts?
Yes. What's going to happen is, including this presentation, we'll send out a link where you'll be able to review the presentation in the future, as well as the audio recording. Well, if there are no further questions, I'd like to thank everybody again for joining us here this afternoon, and again, look for the links that will be emailed shortly.
Thank you very much.
Thank you.
Thank you. Please stand by.